Hey everyone, when you're trading in financial markets, you will make plenty of mistakes. The real error is not learning from those mistakes. After many trades across various pairs, it became clear to us that order blocks work better and yield profits when paired with specific conditions. So in this video we will break down the concept of order blocks in trading using a rule-based method for identifying order blocks respected by the market. We will cover the necessary conditions for a valid order block, how to accurately mark and trade them on the chart, plus the internal and external market structure concepts that need to be combined with the order block strategy. So if this interests you, don't forget to hit the like button to support and subscribe to our channel as we regularly share it. Welcome back, and let's dive in. Generally, order blocks represent zones where buying or selling orders accumulate. The market has previously rejected these levels, so when price revisits them it could respond again. Every order block is a supply or demand zone, but not every supply or demand zone meets the criteria of an order block. Let me demonstrate how each reaction to a price level forms a supply or demand zone. It indicates that traders have entered large buy or sell positions, causing notable price shifts. So when price comes back to these zones, we carefully watch price action to identify potential trading setups, but trading every supply and demand zone won't be efficient. Over time and observing recurring patterns on the chart, we found that when supply and demand zones meet specific conditions, their effectiveness improves greatly. One of the crucial supply and demand zones is order blocks. So first we'll review the conditions needed to identify a valid order block for trading, then I'll demonstrate how to accurately mark them on the chart. So let's move forward with the rules for a valid order block. The first rule involves the presence of inefficiency. Inefficiency, imbalance, and fair value gaps are closely related concepts. When a significant influx of capital hits the market, it disrupts the balance between buyers and sellers, leading to fair value gap formations between candles, which represent a phase of inefficiency. These shifts on the chart indicate that smart money has influenced the market and driven the price movement. Price frequently revisits these zones to fill the leftover orders, which presents a trading opportunity. The price moves strongly after hitting order blocks, but only when unfilled orders are still present. So a supply or demand zone that caused fair value gaps turns into a key level. We consistently highlight fair value gaps on the chart while analyzing market structure, which is the first step in identifying a valid order block. The second condition for a valid order block is a break in the market structure. In a bullish setup, when a price move breaks the recent market structure and closes above the previous high, the starting point of that move gains major significance. It signals that the demand zone behind the move is not just a regular level but a key area within the market structure. With that in mind, a supply or demand zone becomes a valid order block when it causes a structural break. The same idea applies in a bearish scenario. When a price move breaks the recent market structure to the downside, the starting point of that move becomes crucial. It indicates that the supply zone behind the move isn't just a typical level but a significant zone within the market structure. Therefore, these supply areas are recognized as valid order blocks. Here we're looking at an upward trend. This is the latest break of structure, indicating that demand still holds control. All these demand zones may seem like potential short entries, but here's a key detail: the origin of this bullish move is critical and offers the most reliable trading setups. There's a strong possibility the rest could fall into a liquidity trap. That's why trades in these zones should be executed with reduced risk. If you're uncertain about spotting a valid structure break or reversal, check out our previous videos on market structure concepts linked in the description. Now let's move to the next rule. Last but certainly not least is liquidity. Liquidity represents the zones where stop losses are positioned. Integrating the liquidity concept with order blocks deepens our insight into market behavior and adds value to our strategic decisions. When liquidity is swept in the direction of the prevailing trend before price reaches a supply or demand zone, it increases the reliability of that zone. Three typical liquidity grab patterns appear regularly on the chart. Each forming before price reaches our order block boosts the probability of a successful trade. Let's begin with the first one. The initial liquidity grab pattern occurs when fair value gaps and an order block zone are located directly beneath our demand area. In this case, there's a strong likelihood that the initial demand zone gets cleared by a liquidity sweep and the price surges after hitting our order block zone. This enhances the strength of our order block zone since the market now holds the necessary liquidity for upcoming moves. Let's begin with the first one. The initial liquidity grab pattern occurs when fair value gaps and an order block zone are located directly beneath our demand area. In this case, there's a strong likelihood that the initial demand zone gets cleared by a liquidity sweep and the price surges after hitting our order block zone. This enhances the strength of our order block zone since the market now holds the necessary liquidity for upcoming moves. So here's a key takeaway: before entering any trade, you should always analyze the left side of the chart to assess the market structure conditions and steer clear of avoidable risks. When this type of setup appears, there's a greater likelihood the move is simply a liquidity grab and not an actual trend reversal. This scenario reinforces the strength of our order block zone, making it a prime opportunity for a long entry. The second liquidity grab pattern involves the formation of equal highs and lows. These levels are attractive zones for traders who rely on traditional support and resistance methods. In a bullish scenario, the area beneath equal lows holds a significant amount of liquidity. If a corrective move includes this type of support formation, it further confirms that conditions are in place for smart money to sweep the liquidity and drive the price upward upon reaching the demand zone. The same principle applies in a bearish scenario where the area above equal highs holds significant liquidity. If a corrective move includes this type of resistance zone, it further confirms that conditions are set for smart money to sweep the liquidity and drive the price lower once it taps into the supply zone. Establishing strict rules for every chart scenario is challenging, but through consistent backtesting and live trading, the key lies in refining your system to align with the conditions that yield the best results for your strategy and identifying valid order blocks. Let me show you how to accurately mark them on the chart. We highlight the final candlestick before a strong bullish surge as our order block zone, regardless of whether it's bullish or bearish in color. We consider this candle the point where critical decisions were made, making it a key area for buy-side interest. When the price revisits this zone, we look to enter a long position with our stop placed just below the marked area. In certain situations, we also wait for added confirmation and refined entry signals on lower time frames, which we'll explore in upcoming videos. The same approach applies to bearish scenarios. We highlight the final candlestick before a sharp bearish movement as our order block zone. This serves as the foundational method for identifying order blocks on the chart. However, in certain cases, we may need to make slight adjustments based on the context. For instance, there are times when a wick extends below the order block candlestick to capture liquidity. In such cases, we include the wick in our zone marking, but this results in a larger order block area to manage. That's why in these situations we seek additional confirmations on lower time frames to enter trades at more optimal price levels. At times, the candlestick forming the order block is quite small. There's a possibility that price may mitigate this zone and respect its low, but this is not a guaranteed rule. When trading on a live chart, you'll often observe the market breaking through these zones before reversing upwards. So when dealing with smaller order blocks, we either place a wider stop loss beneath the zone or expand the zone to include a broader range on both sides. But how can we determine if this candle is smaller than the typical candlestick range? We do that by using the ATR indicator on the chart. The average true range, or ATR, is a tool that tracks market volatility. It calculates the average size of the last 14 candles based on its default configuration. So here's an extra rule for marking the order block zone. If the order block candlestick is smaller than 60% of the ATR value, we will extend the zone to one full ATR on both sides. For example, if the ATR indicates that the average candle size over the past 14 periods is 20 pips and the order block is less than 60% of that, which is 12 pips, then we will extend the zone to cover 20 pips in total. Based on market structure concepts, three types of order blocks can form on the chart: continuation, reversal, and ranging order blocks. Continuation order blocks form when the market is trending either upward or downward, and the order blocks align with the prevailing trend direction. For example, imagine an uptrend characterized by a series of higher highs and higher lows. Each demand order block that forms along this path presents an opportunity to go long, aligned with the dominant bullish trend. However, if a change of character, CHO, occurs, such as a break in the structure to the downside, a supply order block may form against the prevailing uptrend. While this indicates a possible reversal, it contrasts with the current trend direction. Generally, continuation order blocks have a higher probability of success since they move with the trend. In contrast, reversal order blocks can offer larger risk to reward ratios, but they come with greater risk and require stronger confirmations. The next type of order block is the ranging order block. This type of order block forms during a range-bound or consolidation phase, where price moves sideways within a defined zone before a significant breakout occurs. When the market finally makes a drastic move, either bullish or bearish, the origin of this move becomes an important area of interest. This origin, often inside the previous range, is marked as a ranging order block. Later, when the price retraces back to this range, we anticipate a rejection from this zone, expecting the market to respect the order block and continue moving in the direction of the breakout. This setup provides a valuable trading opportunity, especially when combined with other confluences like liquidity grabs, fair value gaps, or market structure shifts. From a visual standpoint, identifying a range zone is relatively straightforward. It often appears as if the price is trapped within a box. However, from a mechanical perspective, we require at least 4 consecutive candles, each closing back inside the range, to confirm its validity. While all the rules and conditions we've discussed so far are essential for recognizing valid order blocks, there's one crucial factor that significantly increases the probability of successful trades: combining order blocks with market structure concepts. Simply identifying an entry zone is not enough to ensure profitable outcomes. That's why we always implement a top-down analysis approach, analyzing the market from higher timeframes down to lower ones, to develop a full understanding of the current market context and anticipate potential price movements more effectively. Our top-down analysis strategy involves 3 key timeframes: 4-hour chart, HTF, higher time frame. This is where we start. We analyze overall market structure, identify the market direction, and mark out the major key levels along with significant supply and demand zones. 1-hour chart, MTF, main time frame. This is our core analysis zone. On the 1H chart, we dive deeper by identifying the trend, spotting breaks of structure, reversals, fair value gaps, liquidity zones, and of course, valid order blocks. This is where most of our strategic decision-making happens. 15-minute chart, LTF, lower time frame. Finally, we drop to the 15M for entry confirmations. This time frame allows us to refine our entries, reduce risk, and time the market with higher precision. And that wraps it up for this video. If you found value in this breakdown, make sure to smash that like button to show your support. And if you're new here, don't forget to subscribe to the channel for more actionable trading content. Catch you in the next episode. Stay sharp and trade smart.